This is Justin Pulitzer. This is my weekend review for Sunday, November 29th, 2015. This is, however, being filmed on Saturday, the 28th. A lot to cover, going to jump in. So let's start off with the 6 keys. I keep explaining that this, to me, is the key to direction in the stock market. You can see the VIX has been relatively weak. We had that super spike on the panic, and it's just been kind of the tide of volatility, so to speak, has been receding, and we are now coming back down into more normalized levels. The risk, of course, being once things get normal, they tend to get a little crazy again. I don't know that we're not going to be in one of these patterns where it's sort of subdued for the rest of the year. Very possible. But I will say down here, you're probably better off buying premium than selling premium. I don't really like selling premium unless we get anything up above these 17s, closer to 18s, and then, of course, sometime between there and like 20, 22 is good. I always am a little cautious if the VIX gets over 25. That tends to put some crash risk into play. You could see what happens here when we spike through there. We got the, the flash crash. So just keep that in mind, that you probably want to be more of a directional player with regard to volatility, meaning buying calls if you think higher or buying puts if you think lower. The dollar is not giving us any cooperation. I had discussed that my biggest fear for the market is for this thing to come back up, retest the old highs, and then make some kind of fib extension still higher. I've been using UUP just because that's an ETF. I think it's easy for people to track. This is roughly close to around 100 in the DX, but you can see we're above this 2568 resistance. It's become a floor of support, and we are kind of grinding higher. So I said in Periscope this week on Friday that I see the dollar as it's sort of a double-edged sword here. The higher the dollar goes, it seems the more the market's anticipating the Fed to raise, but the more the dollar goes, maybe the less likely the Fed is to raise because they have concerns about a strong dollar. So that's just sort of what I'm thinking. I am very cautious with this. As we know, the higher the dollar goes, the more that hurts corporate earnings, and that might not hurt immediately, but it will hurt longer term. Let's go into the bonds, the TLT. So we're kind of just in a bit of a sideways mode here in anticipation of the Fed. I had said that I thought we had ended the downtrend here, and I thought we might be ending a new upcycle in terms of bonds. But we started making lower lows and lower highs, and that gets a little iffy. Here we had the break, and now we're kind of retracing back up to maybe the potentially a new down channel and the backside of the old up channel. I'm a little cautious with regard to the bonds here. I've been saying that I think we really need lower for longer with the Fed. You know, the Atlanta Fed just came out the other day, and they lowered their GDP forecast from 2.3%, I believe, to 1.9%, which is a ginormous revision lower. That is pretty big. I believe that the Fed really is concerned about growth. They've been doing their best, though, to let people think that they're going to raise interest rates. The statistics, unfortunately, are against us a little bit here. I think that they're still clocking about a 70% chance that they could hike, coming up from almost zero. I believe that just a lot of people had been caught off sides, and they got caught in a bit of a squeeze, meaning this. And I think that things are kind of going to normalize. My guess is when we come into the Fed, it probably won't be as lopsided as that. I've maintained a lower for longer thesis that I believe the Fed won't raise in 2015. I am sticking that course, but it is getting, I will say, ever harder to do that with all of the talk that these guys keep basically saying they're going to raise rates. I mean, when people say they're going to do something long enough, I tend to start to believe them. So that would be, in my view, a policy error. I think there will be major consequences to pay in the stock market, if not immediately, eventually, that could lead to a recession. I've been talking about the crashing commodity prices. I'm going to show you the reason why the Fed raises interest rates is because they have either out of control inflation or a roaring economy. And I don't know about you, but this to me does not look like out of control inflation. If anything, to me, it looks like a deflation. I know the Fed is very Ivory Tower talking about theoretical inflation when in fact they have actual real deflation. I'm going to show you the scariest chart the Fed should be watching, and that is copper. This has for a very long time been a barometer for global growth, and you can see it has been in a steady downtrend, and we are now making new lows. I'm gonna even take this out even further. Let's get real extreme here into weeklies. You can see this was the crash low in 2008 and 2009. You can see we had a new recovery high, and now we are back down to a 78.6% Fibonacci retracement. That is pretty bad. If this doesn't hold here, you're probably going to see close to the full retracement. I don't know if you get the full extent, but you could definitely see the obscene number well into the dollars. So this is really a do or die level here. We had multiple tests here. I'm going to try and show that. I think a 1 year should do it. See multiple tests here. Finally, the breakdown. If this has any semblance of health, there should be at least a check back here, and either you're going to have a rejection lower or a move higher up into here. But I mean, that would still be really, really weak. I don't understand what they're talking about when they talk about potential inflation risks when they don't even see their own estimates being reached until 2018. I don't want to get too much more into this. I've discussed this ad infinitum in the past, so let's kind of leave it there. The ways I've been discussing playing this is with Exxon. I've said for a while that 83 is an important level, and then 86 being the kind of the pass, don't pass line for global growth. I don't want to get too much into that. Why I have those numbers, just I do. And for here, we had this crash down to 66s, a run up to 87s, and now we're kind of getting back more middle range. We are still above the downtrend, which is, I guess, good. We had a bit of a look below and fail. We came back up. We're kind of just riding the backside of that. I've been saying for a while I wouldn't be surprised to see one of these fibs retraced. I'm looking to I have a put ratio on, I believe, in Exxon. I forget what the exact numbers are, but it's probably long somewhere down near 75 or 76. You can see that you have a 50% fib around 77, the 61.8 around 74.53, and the breakout of the bear flag was 75.98. Let's just say 76. So I was really hoping we were going to just come down in a straight fashion. It makes it less attractive if we come down now, but I do believe in here there will be some support garnered. A play, I don't talk about this stock very often, this Royal Caribbean. I know a lot of guys, I shouldn't say a lot of guys, but I have a couple of people that play this that I know. My fear with this here is that we did get a 1.618 fib extension around 97.70. We did get the move to the figure, the 100, and now we're kind of rolling back over. So you're below the 50, you have a swing low here, a consolidation, and now a new swing low. However, we are on a defined channel low. This is really key. This is, to me, a right or right out level if you're a bull. My big fear, though, is that you have a left shoulder, a potential head, and maybe a right shoulder that could form here. And if that happens, it's going to start looking like a head and shoulders or a rounded top, and the move could be lower. The thesis behind that being that oil prices, I'm in the camp that I think oil prices are bottoming. It's possible they can go a bit lower. I've said 33 and 37 in the past would be, kind of the downside risk, but this could be a tougher year-over-year comparison. Those cruise ships use up a lot of gas, and next year it could set up to be, very tough year-over-year comparisons, like let's say if oil goes back to 75 or even 60, maybe even 100. I mean, who knows? Things are heating up pretty violently in the Middle East. You have ISIS going kind of wild. You have Russia's over there now with Putin. Things are heating up. That could happen rather quickly. I'm a little cautious with this. There's also fears of terror. That said, you have some really good defined lows. If you want to play right or right out long versus 91.38, to me that makes a lot of sense. After that, I would be looking to play short for a move to fill up some of this triangle, maybe down to the 85s, potentially even down to the flash crash low here around 79, 73. We'll see how that goes. If you want to really, let's use another tool here. I'm surprised I don't have it drawn in. But let's use those fib retracements. And you can draw that there. You can see that the 61.8 is down near where this big volume node is. It's also close to this flash crash low, so I would be interested if this kind of snaps, playing it short for a move down to there, and with put spreads or put ratios, and then maybe to reverse long, maybe selling some out of the money puts if it came down there for at least a bounce up, considering we are coming down off of all-time highs. Who knows? Maybe I'll be wrong. Maybe this will just shoot back up and you can have room to the upper channel again, but we'll have to see. China. Gotta have your China. Anyway, this has been a big, we had the big run up. This has been a big move down. It's kind of just been bear flagging and a bit of a channel higher. I've said that I don't really care if China goes up or just goes sideways, as long as it's just not in crash mode. Friday's setup was pretty ugly. You had China, Shanghai down 5%. However, look where we are, right on the channel low. There should be some support here. If not, things could get a little slippery with China again. I would be real iffy, but this could be a good right or right out play. You also, if things do get really squirrely, I'm trying to zoom in here. Oh, there we go. I don't know how squirrely they're going to get. Look, we're close to a 50% fib, and then the 61.8, is kind of just a little bit lower. I'd be interested actually in selling some puts maybe for some short-term play, considering we've bombed out here on the stochastics a lot, and we've had a lot of time to kind of go down lower. I would be looking to sell those near dated, like the same week or maybe the following week, for some type of a right or right out play for a bounce. Because if the channel does snap, there could always be a throwback to test the backside of it. We did get back down to like the breakdown level you can see here that I cited, and that was resistance, so it's no surprise that it's kind of rolling back over a bit. I've discussed this BABA for a while. Singles day was 11.11. We topped out a little bit before then in anticipation. We're coming down. There's a bit of a bounce. I would think that the assumption would be if we follow the pattern from last year, we're going to come back down potentially to fill the gap or to one of these fib levels. I don't know that that's going to happen. BABA isn't really as terrible of a company as I think people have made it out to be. It has been a god-awful stock for a year with tons of lockups and some insider selling. Right now, you're kind of just in a bit of a responsive zone. This was really the big breakdown. This was the reference low back from the IPO. Let's see if I could go back that far. You can see here, this was the reference low, and in here was kind of some, I guess, attempts to buy the dip. Look where we got into, right into this area, and it just has some responsive sellers. You can see this was the meat of this volume distribution. So it doesn't surprise me that there were some sellers. I think that you can, I guess if you're long, it's kind of okay. If you start losing these levels, the 77, 77, and these like hammers here, the 76s, you can see there was some reference support there. Then I think this thing is cooked and you can play it for sure short. But if this starts just kind of hanging out here and building up, a bit of a base as the stochastics are rolling over, then, maybe it wants to have a move back up into the hundreds. I do think that that will happen at some point. I just don't know if we have to go lower before then. BIDU, I was bullish on this for earnings. It did what I thought it would do. It got up, it filled the gap. Now we're kind of just hanging out here, consolidating. Yeah, it's pretty bullish. I mean, it's really overbought on the stochastics. I probably wouldn't be chasing it here, considering you had this big move up. I'd be looking for some more consolidation, considering also that this was really where the big breakdown levels were. So that's what I think. There's some responsive sellers. There's also some big volume nodes up here. Still a pretty bullish chart. It did break the downtrend, but it is consolidating. It kind of tried to break out, looked back in. So if you want, I would say use this big breakout bar day as your guide. Anything above 204.82 is bullish. Anything below 196.52 to me gets more bearish. Keep it simple, stupid. So that was China. Let's talk about the IBB. That's the last key. That is, to me, been a major tell for a while. Let me zoom in here. So you had a head and shoulders top, the breakdown, the check back, Another breakdown, double bottom lows for the most part, bear flag, attempted breakout, still holding within the channel. Finally, we're breaking out here, and these highs are being challenged. You did have a little bit of a look above here, but you did close below. So and we are a little bit overbought here on the stochastics, but I will say the IBB looks like it is really trying. This area was really some key support before. It's going to be some key resistance now. You have a big volume distribution here. So I'm a little bit more optimistic on this. You can see that the 50 MA here, and a little bit here was resistance. We tried to get above it, supported, got back below. So I think you could probably play it long off the 50-day moving average if there is some type of a pullback for some type of a right or right out trade. Maybe it's trying to form an inverse head and shoulders here, where you have the head and then, the left and the right shoulders here. So we'll see how that goes. I wouldn't mind this even just still going sideways, but let's keep it simple. Again, with the breakout bar, anything above the 339.01, bullish. Anything below 329.32, to me, gets really bearish. I would be real bearish if we lost this candle. So let's keep it like that. A lot of the weakness has come from stocks like this Valiant. I think we all know about Bill Ackman. I mean, a stock chart like this, if you don't have a drinking problem when you start, you end with one. This is, you want to take away the shoelaces and the sharp objects. This is career-ending type of moves. So head and shoulders top, breakdown, consolidation, breakdown, held primary trend, bounced, came back down, retested, a smaller bounce, finally snapped, got lower, and then just kind of retested the breakdown level. Anything to me below 88.5 is suspect and dangerous. If you're short, you can use this high, this 97.64 as a stop. Anything back above there, I think you're going to probably get a squeeze. But it is just consolidating above the trend line here, and it, to me, looks very much in danger of doing one of these and having another leg lower. I know that guy, I can't think of his name offhand for some reason, but the Citron Research guy, he's been talking about $50. Maybe it does want to come back down there. The launch point was 42. It's possible we just do some consolidation here. I don't know that this stock is a zero, but these are the kind of things that I think tax law selling is going to prevent really from having too much of a rally into the year end. That said, this thing is really bombed out. I really, to me, wouldn't be shorting this thing after it's come down this much, but I don't know that I would be long it either. 88.5, that's the pass don't pass line. Above there, it gets more bullish. Below there is still suspect. One I do like, although I am concerned about with all this jibber jabber from the likes of the Hillary Clintons, is Gilead. Not very expensive based on earnings, but that is assuming we haven't reached peak biotech earnings. What does that mean? It means PE multiples, like in commodities, are always the lowest when they've hit the peak earnings. If there's a lot of regulation that comes into this stock from now on, there could be some real trouble with regard to their PE multiple. The stock might seem a lot more expensive. So we're in a bit of a consolidation pennant pattern. This to me looks like it could either resolve. I mean, it's either going to resolve one way. It's either going to resolve higher or it's going to resolve lower. I would wait for the pennant to break. If you can take out these swing highs, you'll probably mosey on up higher. If you lose these ones, you're probably going to mosey on down lower. Really simple compression pattern. Lower highs, higher lows. I'd wait for the break and then go with it. Simple. Alrighty. Okay, let's get into the major market indices. I know this chart is a little muddled looking, but it is mine, and it is the one I actually use. So the danger here with SPY is, of course, having some kind of a big rounded top pattern. Look where this low was. Look where this low was. It's basically identical. This rallied up high enough here to be a very dangerous lower high if this does wind up rolling back over again. Like if this were to come up here, now it made a still lower high. If we took out these lows, I'm going to start thinking that the top of the market could really be in. Anything to me below this 201.90, which was the old highs here, You can see the it's supported here on the pullback and rallied. Anything below there to me gets real iffy, and you'd probably have the 197.86 in play. And if you lose that, I think it's going to be really lights out for the market. I mean, I think you'll see a decline of the likes you may have not seen in, a number of years. That being said, we are a little late in the year for that, and, the market has kind of held up well. You had this big consolidation pattern. You had a rather large liquidation break, a rally, a very successful retest, and I basically called this almost to the tick. I think I was off by like a couple of ticks, or maybe like even a few minutes. I said that in a video, all documented, that these lows I thought would hold. I didn't, the pullback, I didn't think we'd retest the full way. It wound up being correct. We rallied to the downtrend, gapped and went. This was on Fed minutes, and then this was the actual Fed. We rallied. We kind of failed, but came back up. So where does that leave us? That leaves us if we're anything above this 208.97, and I've even said 207 is really the key. If you look at this pullback low here, it was 206.95. And that held. We got back below there. Look where this topped out here, this sort of reversal bar was 207.04. We kind of tried to pull back, and once we cleared that, it was kind of all, I would say that the tone of the market really was starting to change, really back to the bulls. And you got a big, look at this, 207, 207. Once the bulls cleared that, it really took on a new life, and it's just been consolidating. So to me, I'm going to just say let's keep it simple, stupid. Anything above 207 to me is still rather okay. Anything below there to me gets iffy for a move maybe down to 204s. I've said this, though, before, that the bulls really need to clear and hold 210. They tried here, and then they kind of lost it, and it's just been building a lot of pressure here sideways. We are kind of making some lower highs than the stochastics. The fear, of course, is the rollover, but it could kind of come back up. I will say anything above 210 is bullish for a move back up to the old all-time highs. Anything below 207, we're going to see, I think, the range low again. So let's keep it simple, stupid with SPY. The expected move next week is like just under $4. I think it's $3.41. That would take you up to about 212.97. And down to like 206.15, I believe. So that's the expected move. 206, 207, like I said, really key. If we start losing those 207s, I'm going to get real cautious. IWM was in a bear flag. I've said it's been weak for a while. We came below this, I guess, bigger distribution. We are now back up above it. It's good that we are now making higher highs and back above the 217.37. However, we are not out of the woods yet. Look at this Fibonacci extension. Look where the 61.8 comes to. The breakdown points. The support was here. The support was here. We kind of tried to rally, and the resistance again became there. This is a 61.8. It's a 200-day moving average. It's where this volume distribution ends. So we could come up here. This could be an actual interesting right or right out short. And when I mean right or right out, I mean right or right out. After multiple days up, we could see here and maybe have some peel back. However, if this breaks, you're probably going to see the channel top pretty quickly up to the 122s. And then that to me would be an even, I guess, better right or right out play for at least some type of a rollback, maybe to the middle of the channel. So the good thing that the problem with IWM rallying is that means to me that, again, could be meaning the Fed is going, because these are companies that have domestic earnings. I think a lot of the weight that's been on this and holding it, off of these highs has been its exposure, to biotech. It has a lot of small cap biotech in there. So we're going to kind of get to a level here where the rubber meets the road between this 120.58 and let's just say 121s. That to me would be the, like I said, that's going to be a really big pass or don't pass line. The kind of prince of the market has been the NASDAQ, the Qs. You could see you had the bit of a breakdown, did not spend much time, held trend, came back up really fast, little bit of a look below, and now we're basically at the all-time highs. We are at all-time highs and made new highs. So pardon me, that is bullish. We're in an uptrend, consolidating, just building a lot of pressure up here. That is, the definition of a bull market. Could it roll over? Yeah, sure, of course. So let's look where that breakdown really came from. The range was the 111.11. The low was 109, basically 49. Look at that. Look where this low stopped here, 109.48. Coincidence? Not really. So if we lose this low, it'll probably have a lot of support again with the 50 and all the 100 and the 200. It's going to be hard to really break this market down because I'm going to show you some of the stocks that are doing this and the bullishness that they've had. So if this were to break now at this point, then I would say that you are in deep, deep trouble with the market. And we could easily see the 61.8 fib and maybe even still lower. However, it looks like this is consolidating for maybe another push higher. Apple, another really messy chart. Fears of a big rounded top are warranted. So let's go micro Apple. So you had this run up, there was a downgrade, then Goldman Sachs kind of counteracted it. The rally was basically back up to the breakdown, the 119.76, 75, basically let's call it 120. Tried to rally back up and now just consolidating. The stock is making lower highs. You can see this high, this lower high. This is still a slightly lower high, potentially lower high. However, starting to make some higher lows. So I'm expecting this stock to kind of consolidate a little more and then have some type of a breakout, push up to fill the gap, which is actually what I think could likely happen. Or it's going to run a roll down and retest into these lows, the 103s and 100s. 115 is really key. It's been key for a while. It's also the 50-day moving average. Let's just keep it simple. 50 above the 50 bullish, below the 50 less bullish and maybe bearish. That's kind of all I want to say on that for the moment. Moving right along, Amazon. Holy cow. Look at this move. To talk about bullish, it got my 1.618 Fibonacci extension. It got even higher. It had the pullback. It didn't even retest the breakout fully. And now it's back up kind of consolidating under the highs. Stock is in clearly overbought territory. The stochastics are starting to make some lower, are starting to kind of bend back over. I can't say that this stock is going to, completely fall apart, but I mean, this stock has gone through periods where it has not been, where it's been frowned upon. You got to think a lot of the bullishness is in this stock, but I will say this, it came out on Black Friday that year-over-year sales online were up 22%. I think I saw one stat at 15% and one stat at 22%. Regardless, that is Amazon's wheelhouse. I told an anecdotal story where I was looking at shoes. I don't really want to repeat myself. But in the store, basically, they were more expensive, and on Amazon, they were cheaper, and I wound up buying them on Amazon. So the world is kind of becoming a showroom for Amazon. They're picking up huge market share. Does it mean that they're worth 1,000 PE multiple or whatever it is, 9 and change? I don't know that, but I do know that their success has been hurting a lot of other companies like the likes of the Macy's and the Nordstroms and the Walmarts, the big box retailers who aren't as nimble and dynamic and who I guess haven't spent as money investing in their online infrastructures. And I think that the dominance for Amazon is going to last for a while. So consolidation pattern, stock still looks pretty bullish. I would just be a little cautious with your entry with regard to buying this. You don't really want to chase it on up days. You kind of want to buy it on downtrend days where you have some reference support to trade against. I guess I drew a channel. This is really the big primary trend you can see from this gap up here. If the stock ever came down there, I would be a big right or right out buyer, particularly if it coincided with some lows. But in the meantime, we're in a new up channel I used from this point. And, we haven't gotten to the channel top. I would look at the sort of the midpoint of that channel as a right or right out trade. I like put ratios or right or right out stock buys there. But like I said, it just looks like consolidation, probably going to press higher. If you're long, it's probably a good idea to maybe put on some protection. I don't think it's really that expensive. The 20 MA held, stock is still rather healthy, so let's use the 20 MA as our immediate term terms of endearment and health. If it can hold 20 MA, still bullish. If it starts getting below there, gets to me a little bit more iffy. And maybe the 50 would be in play in that instance. Chipotle, not exactly the poster child for healthy. This stock, we all know over the years, has been really bullish. It was in a big up channel. It lost the up channel. It retested the up channel, fell apart, kind of tried to bounce again, and then we all know what happened here. More E. coli worries. You know, the truth of the matter is, and I've said this for a while, is that the line of least resistance, the news always falls along the line of least resistance. And these kind of lows here, this 595, what was this, 594, the 61.8 here was around 580. This bounced and then subsequently was taken out in rather aggressive fashion. So if you're below these lows, this like 80, 81, I'd be really cautious still for maybe another leg lower. The stock could, let me see, what was this, 3 years daily? The stock might want to, believe it or not, come down all the way down to these 440s and retest the big breakout. That looks like it could be possible, you know. Down, little rally, and then down again, maybe on some kind of junky earnings number. Would I first initiate shorts here? Probably on a rally back up to the downtrend line. That would be a good right or right out type of a play. That being said, the stock is down really ginormous, 200 points. Probably not something I'd want to chase to the downside. On like an upswing, maybe the 20 MA confluence with the downtrend line would be a good right or right out short. You can see this is where the supports were. Like if there was some type of a pop, you see where the volume distribution is up around the 600s. That to me would be an interesting point in terms of right or right out play. Bombed out stochastically, not really looking to short unless it's on a bounce. With regard to a rollover, if you start losing these kind of pullback lows and you start getting back into this area, it's probably going to roll over again. So that's Chipotle. Facebook, I drew this box. I know this is maybe the messiest of messy charts. Apologies. I think we can get rid of this fib for now. So you can see we rallied here the last time on Google earnings. Again, the same thing, and then their numbers were pretty good. They're just in a consolidation mode. My fear here is it has a bit of a fall out of bed. You can see it kind of consolidated here, tried to rally, and then came back lower. So I don't necessarily know that if you're long that you need to be panicky. I will just say this, though. I've drawn in this upward regression line. We hit it here. We hit it here, again here. Major back-offs, you can see. We hit it again here, and now we're kind of just trying to stay with it. I'm a little worried that there is going to be a bit of more of a back-off. I would say I'm a little disappointed that this low didn't come back and really retest the breakout properly. I wouldn't have even mind if it pressed a little bit lower to retest the 96s, since you can see that's really where these highs were and the bodies were, so to speak. That, to me, would have been the most healthy, but people bought it up, and they tried breaking back into the channel. Now we're a bit back below it. I just think this thing is kind of riding out some of its overbought condition and probably may have a little bit more sideways and chop to go. I would be interested in buying it somewhere in the between 93 and 96, probably via short out of the money puts near dated. Google. Bullish. Sorry, just is. It is getting a little bit late in the ball game, though, in terms of the channels. This could have another push up to get the 800 number, and then maybe it could be a little, have a little bit more correction. It is kind of working off some of its overboughtness in the stochastics. Again, another stock that goes through fits and starts. I'd be more interested in some type of a when it has a move back down into some reference support. But if you're long, anything above 752.05, bullish. Anything above 769.08, even more bullish. Still bullish. More bullish still, so to speak. Again, look at this. 20 MA held. 20 MA. Let's just use the 20. Above 20, bullish. Below 20, less bullish. Simple. Netflix. I drew out a possible scenario that this could just be in an up channel. It's kind of resisting up there. Maybe we get a pullback to retest the breakout, and then it goes up to new all-time highs. It could also just chop sideways and get there. I do believe that this stock is doing really well. They've had some really good proprietary content. We all know about Orange is the New Black and House of Cards. Now they're getting into it with Marvel, with that Jessica Jones, which is a pretty good show. I'm actually almost a little more than halfway through it. I wouldn't be surprised to see some type of a Fibonacci extension here. I don't have it drawn in here, but I believe it would take it up into the 150s. Wouldn't be a shocker in the least. As long as we're above 115, it's bullish. If you start getting into the 110s, between 110 and 115, it starts getting a little bit iffy. As long as it's above the 110, though, that to me isn't too bad. I would love to see, honestly, if I had my druthers, the absolute best play would be for this to now just go sideways and kind of work its way lower, get down to the 110 at the channel low, and that would set up for an amazing right or right out. So we'll see how that goes. I don't know if we're going to get our wish there. This may just want to continue floating higher. Bullish, stock is bullish. Priceline. So this I had shown for a while was in a big channel. Let me go back and you can see. Yeah, you can see big channel here, resistance, again resistance. Now we're back at the channel low. A lot of this is on terror fears. It bounced. It's not a really super duper strong bounce, but bounced nonetheless. I would say you can probably play this long against the 200-day, against this low now maybe. I don't know if I'd want to give it all that much room here, but against this low of 1230.21, anything above there to me is okay long. Anything below there gets a little iffy. If this low were to snap, I don't really know where we would go. I would assume the 61.8 here would be the first target, which is 1176, but the real risk is that this kind of really rolls over and chests the primary trend down in like the thousands to 1100 area. You can see there are some reference lows even back here, close to the 1087. That was a very prominent, important point. So that to me would be a potential danger. So long, I guess here with the caveat that if we start losing these areas here, it's trouble. Down here was a good area to sell out of the money puts. It's bounced a bit, so let's just see what happens. But I would say that the risk here is probably a bounce higher, some type of a fib retracement from the high to the low. Again, this has come down like 200 something bucks in a straight line. Probably well overdone on the stochastics. So let's just keep it simple. Long versus that low. You could use the 200 MA if you want, and anything below these lows is a short. All right, let's talk about a couple of other ones on the stream. People had asked me about Nike. This one looked like it was in danger of really rolling over. You can see here, we all know what happened here. They announced a stock split. They announced a big share buyback and an increase of the dividend. Saved the stock. A couple of days of consolidation going still higher at new all-time highs. Could easily see the new channel high. The channel high up in the 140s wouldn't surprise me in the least. I believe that the stock is going to remain bullish into their split, and after that, I don't necessarily know if it's going to be a Skechers situation. This was a 3-for-1 stock split, and then the thing got nailed. I discussed selling puts down here in the 25s. It worked. I think I'm out of them at this point. It's back down to like sort of where the more breakdown came. So if there's some type of a rollover here and a successful retest, that would be great. My big fear for this was that this came down to close to 21s. There's a gap fill around 2078, and 2156 was the breakout. I was sort of actually hoping this would still go lower. I discussed buying it down here as a starter position. It wasn't really full size. With the full intention of adding if it came down here. I really rarely do that, but I thought that this could be my fear I wouldn't say fear, my fear or hope or what I thought could happen after this many multiple days. Look at this big gap down and then another leg down. I figured this gap fill would have some muscle memory, and it did. It wound up working out really well, but I did have the full intention that I knew that this was a bigger, even still stronger support, and I would be comfortable adding to a quote-unquote loser. but it wasn't really a loser. It was going to just be sort of like a tester here, and then this would have been the more full-size position. As it wound up, the tester wound up just working, and the trade was a win. I never countenance adding to losing positions if that isn't your intention from the beginning. So it wouldn't kind of be like I bought here and then, it came lower, I must buy here. It was that this was a gap fill area that I knew was a key support, close to a fib level, and then this was the breakout and sort of a bigger gap fill that would have traversed the entire move up, and that to me would have been the kind of even better place to start. So that's Skechers. I have a couple of little concerns with Under Armour, for example. You can see that this stock is sort of forming a bit of a rounded top, a little bit of a head and shoulders, lower lows, lower highs. It's really just kind of at the channel lows here, and my fear is, of course, this thing snaps here and comes back down. So I probably wouldn't be involved with this stock long until it at the very least, breaks the downtrend here. You can see that it's not responding well to rallies. It's being sold, and it's being sold and then making new lows. So I would wait to see if I were looking to buy this, for a right or right out play. I think here was a good opportunity, although we did break the channel. It's coming back down, so I would say maybe can play long against this 88.15 maybe if it comes down, like the channel low, the 200 MA, so somewhere in here. But I would feel more comfortable if this were to make, let's say, a higher low and then take out one of these swing highs and then play for a move back higher. So that's sort of my story with regard to Under Armour. The other one that's been showing a lot of weakness in the market is this Disney. Let me get rid of some of this remove drawing. So anyway, you can see Disney had the lower subscriber numbers. It had this big gap down, consolidated, then went lower, kind of roughly held this trend from a while back. You can see you've had some small violations, and it's been rallying really back up to try to fill most of the gap. Unfortunately, it had some bad news again with ESPN losing subscribers, and usually once you've had a stock that rallies back all the way up, it kind of has people who were long and sat through this, and they're just like, let me get, I have the opportunity to sell the highs again, let me do it. So I've been a little bit bearish on Disney. I know they have Star Wars coming out. I know that they have a lot of positives going for them. But I don't think that this problem of losing the ESPN subscribers is going to go away so quickly. I wanted to show you one other thing. This stuff really works, the technicals. Look at this. You had from this gap down here, you had a trend line that basically came up. You got to the backside of that trend line. You almost got to the backside of this trend line, and that's where the thing kind of started to fall apart. I would think at the very least you probably get a retest here of these lows. It did hold this low. That is a little constructive for the bulls. I don't know that the stock is going to roll over as dramatically as it did the last time, but I would think that it could really, start really coming back down. The stock is trading at a pretty high PE. It's at, basically near all-time highs. I think it wouldn't surprise me to see this thing to start to roll over again. I haven't talked about this before, this Align. You can see this 65 area was a key resistance for a while. It's above there trading. I think that this stock could have a lot of potential. These guys make the Invisalign, the braces. It goes through periods of time where it is not liked, like here, like here, like here. Just wait for one of those and then maybe, nibble some. I would love it somewhere between 55 and 58. I think that would be a great buy. I don't know that we're going to get lucky again to buy it there, but look at this. This is sort of the midpoint of the range. These 50, this area here, this 58, it might press a little lower into the 57s, the 55s. I would be very interested in a right or right out, maybe even sell some puts down there. You can see this was kind of like the breakout. So let's sort of just hope for a rollover. I don't know if we're going to get it. It might just want to break out. So anything above 68.48 is probably a long because it's consolidated here for so long. That would be a breakout. Anything back down here, I'd be interested in buying somewhere on one of the fibs or on the trend. I think we could end it there. We've gone kind of long enough. I've been talking for about 41 minutes. I was hoping to get into some of the silliness stocks with the GoPros or whatever, still showing tons of weakness. I'll cover that maybe in Periscope this week. Anyway, let's have a good rest of our weekend. If you're not following me, follow me on Twitter. My handle is @JustinPulitzer. If you liked this video, hit the thumbs up. It's just below. Please leave a comment. Your comments help me make the videos better. And be sure to subscribe. Just hit the subscribe button. You'll get notifications when I post new videos. I post all of my weekend review videos like this. If you ever miss a Periscope, I post the rebroadcast and, of course, special edition videos. So let's have a good rest of our weekend, and cheers.